Okay, so now it's time for our first panel discussion, Trade on Chain or Mr. Train. Please welcome our moderator. Let me quickly confirm. Liz from Alchemy, along with our panelists, Alexander, contributor at Aerodrome and Velodrome, Valentin, General Manager, dYdX Operations subDAO, Felix, DeFi trader at Wintermute, and Momir, managing partner at IOSG Ventures. Welcome. Just to do a quick mic check. Everyone's mic is working, right?
Yeah. Hello?
Yeah.
Hello? I don't know. Is mine working?
Yeah, okay. It's working.
Hey, everyone. We have this amazing panel here today. Let's just kick us off with first question. What convinces CEX traders to make their first on-chain trade? And what convinces them to do the next 5 transactions on-chain? I'm going to kick it off with Valentin.
Yeah. So I can think of a couple of reasons why a trader would move to a DEX from a centralized exchange. First, if they look to trade more the long tail of the assets, so I think the offering on decentralized exchanges is just larger. There's all of the coins are there. That's one. The second one is the ownership of the assets and the control. So like the recent Bybit instance or frauds like FTX can push centralized exchange users to a DEX where they hold their crypto and their responsibility. And why they would stay, I think it's a combination of these things. Additionally, the transparency of trading on-chain is a big differentiator, in my opinion, to centralized exchanges. It is clear to the trader who they trade against. If there is, as the talk before mentioned, MEV, it is visible on-chain. People can investigate that. With centralized exchanges, it's more of a black box, and you have to trust that it is done in a fair fashion.
Does anyone else want to add to that?
Yeah, I can add to that. So I think today, or what has driven like a lot of on-chain trading over the last 6 months, I guess, were meme coins and AI tokens. And I think the reason a lot of traders chose to trade on these decentralized exchanges is just because they access to these long-tail tokens. They were listed on centralized exchanges. Eventually, will list these tokens, but if you want to have early access, you have to go on-chain. And secondly, I think for some of these tokens, liquidity is actually better on-chain. If you have a meme coin that's launched on pump.fun, most of the liquidity initially will be on Radium or any of the other Solana AMMs. Which means you'll actually end up getting pretty good execution on-chain. And I think one thing to add on why traders might stay is that once you're set up on-chain, you immediately get access to all the other protocols deployed on that chain. Now, it depends on what you're interested in, but you get access to money markets, you get access to liquid staking coins, yeah, so that might be another reason people stay.
I can follow up, but yeah, first of all, hello everyone, Momir here from IOSG Ventures, and yeah, thanks for Team Futures for organizing this event. I think it's mostly just because of access to alpha. I think the reality is that most people don't care about centralization or decentralization. It is more about how to get closer to the alpha, and recently, I think what we see is also emergence of more and more trading terminals that are kind of offering centralized custodial experience, but on-chain liquidity. So I think this sort of on-chain experience is something that a lot of centralized exchange users have interest in because they can trade with one click, they get gas fees abstracted, and they basically get to have the same experience as on centralized exchange, but they get access to unlimited tokens, and they don't need to wait for tier 2, tier 3 exchanges to kind of list these. And if you look into the user profile of most of the tier 2 and tier 3 exchanges, actually, like the value prop that these exchanges offer is mostly access to more tokens, right? And I think this trend of trading terminals and hybrid exchange platforms is to some extent very dangerous for these tier 2 and tier 3 exchanges. But even when we had Hyperliquid, which is some sort of on-chain experience, it's also rather centralized. And I think in this whole cycle, like users have shown that they care just about product experience and access to alpha, and that decentralization is not the main thing, which is unfortunate for many DeFi builders, but that's the fact. I think if you look into the success stories of this cycle, like Hyperliquid, Ethena, also Usual that scaled at $1.8 billion, they're all like kind of CDFI applications, and maybe like hacks like Bybit one remind again users about the value of decentralization, but usually people tend to think about decentralization after the fact, and it's not something that is driving the usage.
Yeah, I mean, just to echo, one is all the tokens are on chain, just some of them are on centralized exchanges. So if you want access to everything all the time, you have to be on chain. And probably very importantly, hasn't come up yet, but lower fees. You know, centralized exchanges take a pretty hefty cut, and I think the on-chain economy can often not only offer you all the tokens, but it costs far less to trade them. And in this more permissionless environment, it's, of course, a bit more fair at times. Lots of central order book shenanigans, things like that happen on centralized exchange. So if you want access to all the tokens and you want to pay the least amount to trade them, I think you have to come on chain.
I think, just to follow up on that, I agree with that, because, for instance, I got wrecked on FTX in the last cycle, and then after that, like my strategy was like, if I use centralized exchanges, I'm going to use the most boring one. So I chose Kraken. Like they have not very good trading experience, high fees and stuff, but I feel like most comfortable holding money over there. So free advertisement for Kraken over here. But I would just hold some amount of money over there, but I would never trade. If I want to trade, I just move money to my on-chain wallet and trade on-chain, because Kraken has such a high fees, and it's very bad from that point of view. So actually, yeah, like I sometimes use it for convenience, for holding money. But if I want to trade, I move money to trade on-chain, because it just I get much better entry price with Kraken. I always get terrible execution.
I actually feel similarly. I pay crazy fees to Gemini because I have some crypto in my Roth IRA. So definitely feel that, and I feel not great about paying the high fees, but I'm happy that I trust Gemini enough to put my retirement money into that. Kind of a follow-up to that is what innovation, be it L2s, better UIs, MEV protection, what has been the biggest unlock for on-chain trading, and what is missing?
I mean, I think the biggest unlock, especially given I think the cycle we've just gone through, is the ability to permissionlessly launch so many tokens, right? I think there are pros and cons to this just nonstop factory of new tokens, but there's no doubt it makes for the most insane dynamic market at any given time. If anybody can show up in permissionless ways, in very simple, easy UX ways, launch a token, trade a token that just launched, and all of that sort of stuff. I think the thing that like we've been working on the Velodrome and Aerodrome side is to bring dynamic fees into the equation, such that in moments of low volatility, you can bring those fees down and ensure that the DEX is capturing sort of the maximum amount of fees. You can raise them in moments of high volatility. And what that essentially brings to you is a bit more of that order book-like experience where LPs are being compensated proportional to the amount that might be taken from them via arbitrage and other mechanisms. But yeah, I mean, it's created the best marketplace in the world. I think we can use technology to make it more of an equivalent to centralized order books. And that will, I guess, even further enhance that sort of on-chain trading experience. And of course, as the chains get so much faster, some of that arbitrage or LVR activity is going to be less present because there's going to be less to arb the faster that the chains go in terms of the dissonance in prices, you know, between the centralized and decentralized exchanges, which again, I think leads you to on-chain being the single best marketplace where you can be trading.
Yeah, I think I'm actually curious how many people in the room have heard of GMGN. Yeah, I actually realized I'm based in Asia, so I realized there is some gap between Asia and Western market, and GMGN is globally speaking probably after Pump.Fund the highest revenue generator in the whole crypto space. Yet on the West nobody knows about it, and it's usually because it's powered by a lot of demand coming from Asian traders, but I think GMGN kind of feeds on Pump.Fund, and probably Pump.Fund has been the biggest change that led to users choosing to trade on-chain. But at the end of the day, what we see is a kind of user behavior. The FOMO is extremely high, so usually people try to trade with the platforms that offer them the best data, because even if this platform charges them 1% fee, they would be okay because they have a FOMO of kind of missing out on a 1 second, and then the time they need to change to a maybe better execution platform won't be worth saving the cost on the fees. So GMGN, they started as a data platform. They kind of offered very advanced analytics on sort of smart traders and filtering out in terms of helping people get to alpha much faster. And then they just introduced the trading feature, which is not very great in itself, but it also charges a very, very hefty fee. But because of such a high FOMO that Pump.Fund introduced with casino on steroids, people are just comfortable paying any sort of fee as long as they're gonna be first to kind of react on something that they perceive as alpha. So I think in this cycle, that's the reality. Again, these MEV protections and stuff, these are not super interesting and for users, and they just care about the perception of being close to alpha and being able to react fast on this.
Yeah, I agree on the MEV protection part. I think these private endpoints or order flow auctions have probably been around for quite a while, but it's mainly been upon apps or wallets to push adoption for them. If you look at the share of private transactions on the Ethereum mainnet, that has grown quite a lot, but most of them that has been driven by wallets sending to private order flow auctions like MEVBlock or MEVShare, or just wallets building their own auctions. But I don't think that's something that's been a blocker for users. I think it's good, they reduce the amount of MEV that's being leaked on chain, but I think I agree that most users care about fast execution and having access to that next 10x meme coin maybe.
Okay, 2 more very exciting questions. The first one I want to direct specifically to you. Felix, you're right. Okay. Beyond just decentralization, what unique trading experiences can an on-chain platform provide that CEXs simply cannot?
So I think there's probably 2 interesting points. One point is definitely, again, the composability. So you have all of these different applications that are deployed on-chain, and exchanges can basically build around all of these Legos, money Legos together. And I think the other thing that I find interesting from a market maker's perspective is that what we see with app-specific chains that are built, specifically built for order books or trading applications. There's a lot of experiments going on with maybe specialized sequencing. Hyperliquid, for example, prioritizes cancels. Like CowSwap is running frequent batch auctions. So I think there's a lot more experimentation of like different market mechanisms, sequencing rules happening on decentralized exchanges, which in theory would probably also be possible on centralized exchanges, but it hasn't really happened yet. And with like specialized layer 2s or specialized layer 1s popping up more and more, I think we'll see more experiments, and it'll be interesting to observe how market microstructure changes like as a result of these experiments.
Yeah, app chains are definitely going crazy. I think they're gonna 1000% have their year this year, and then who knows? It's crypto. And this one question is specifically for Valentin, and then whoever wants to add on. What is one regulation you wish policymakers would pass that would benefit your business? In this case, dYdX.
Yeah, I think first and foremost, what the industry needs overall is clarity. I think there is not bad regulation. There is no regulation, at least in America, in one of the most important markets, and specifically for decentralized exchanges, clarity on what does decentralization mean, and clarity around what a decentralized exchange can offer to users or residents of any given jurisdiction, first and foremost. And secondly, I think that the importance of KYC is somehow overemphasized in contrast to AML, because we don't necessarily care where you come from, but we want to know that your money is clean. And there's especially on-chain, there's different ways of making sure that is the case without necessarily knowing who the wallet holder is. Yeah, those are the two.
Yeah, I could jump in. I mean, I think what we know is that on-chain markets have the opportunity to be the best markets in the world, right? They're real-time, they are permissionless, they are always on, right? But right now, most things that trade do not trade on on-chain markets. So you have a gap between technology that, in theory, can service as the best marketplace for trading just about everything, and we can say everything from the range of crazy meme coins to stocks and equities and derivatives and things like that. But the major gap, I think, to enabling that has been the lack of regulatory clarity, or in fact, just the opposite of complete regulatory overreach, right? And saying that all of these things are securities. But I think what we've begun to see, or are seeing the early signals of, is both from the regulatory bodies and the SEC talking about sandboxing crypto, right, and giving the opportunity, especially where pools are permissionless and protocols are permissionless, that you can have a big sandbox for experimentation. And you just had the federal court, dismissing the complaint against Uniswap that said, hey, you can't basically treat a decentralized exchange like you would any traditional financial market. So what does this mean? If we do get this kind of clarity, it means we can bring everything on chain to trade. So we're big builders on the Base network, and the Coinbase team has said very explicitly their goal this year is to bring Coinbase stock on chain. And if they do that, right, and we bring a whole bunch of other asset classes on chain, and because of the permissionless structure, we have the ability to build around and service those markets, and those now on-chain representations unlock the composability of DeFi, and you can do all these things with these assets, excuse me, that you've never been able to do before. I think that's where it gets exciting, and you think about markets that are orders of magnitude larger than the ones we currently service.
I was just going to say, I'm actually really curious. I'm pretty sure everyone except for Alexander, all of you guys live outside of the US. So I guess my question was, it seems like questions about policy is very American-centric. Is there anything going on in other countries that would benefit your business too? Or not really, because the American audience is just so strong.
I think the American audience is just it's 350 million people that are one market. Obviously, the EU is 500 million people, but the market is much more fragmented, different languages, different cultures, and so on and so forth. There is regulation, and we are dealing with it, but it is also not clear on what decentralization is. It's also not clear if there is a differentiation between decentralized exchanges and centralized exchanges. So that portion is missing from MiCA, for example, specifically, which focuses on digital assets but does not kind of specify that in my mind, very important distinction. So the call for clarity stands also there.
I think it would be great if European regulators do nothing because they have terrible track record. And I feel like no other country has the power to enforce certain decisions as much as the US. And at the end of the day, US is the largest capital markets in the world. So if we want to get this money on chain, we still need to rely on the US regulator. And if I had one message, I think it would be also to ask regulators to punish scammers, because occasionally crypto people even wonder whether can you succeed in crypto without being on the edge of becoming scammy. And I think now with maybe the only negative thing about the new administration is that everybody started thinking that they can do more scammy things and get away with it. So I think that's maybe something that would be great to see change.
Yeah. Well, thank you guys so much for being here. This is the end of the session. Hope the guests get to have a break now.
Thank you.
Thank you.